Today I'm going to approach this from two perspectives. One is equities, where are equities going based on tariffs? And the other is a little more oriented to the economy. Where's the economy going due to tariffs? Everything is about tariffs, as you know. So Sim Carlson is being interviewed by Adam Taggart. He gives his view on the market and where equities are going, especially in the next year or so. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is April 15th, 2025. I play Adam Taggart in his interviews some because he does a really good job of asking good questions. He has on excellent guests, and this time is Sim Carlson. Sim Carson. And so he gives a view that during the first quarter of 2024, equities were down about 20%. He looks at a longer period, and he's an analyst, so he sells his research to Wall Street and others. And in his analysis from him and his company, their view is that we are in for a multi-year decline. And that the market is likely through that period of time to go down as much as 35 to 45%. Not as much as what in great financial crisis, I think the S&P went down 56%, and the NASDAQ went down 85% during the dot-com bubble that crashed. So not as much as that, but 35 to 45 is a lot. So we've just been down 20 at the lowest point in that range. And so he is expecting a lot more. And so he sees that happening in periods of time. He says we're kind of past the first period, maybe the first inning, so to speak. From here, the market may go up a little bit for a while, but eventually, for various reasons, the market will eventually collapse on down and go down further. Try to go back up and go back down. If you look at periods of decline or deeper decline, say 30% or more, you see that almost always is the case, where it will go down. I can think of 2022. I go back to 2008 or 2000, 2001, 2002. During those periods, again, declines, try to go up, and then further collapses. Go back into the 70s, the 73, 74, 79 to 81. They all happen like that. A little different things cause them to do that, but in different ways. So we manage money tactically. We're in the market at times, and we're out of the market at times. This is probably going to play into our hand better than a general uptrending market. Both would play into our hand, but this, I think, is going to favor active investing a lot more than traditional buy and hold investing. It will frustrate investors doing a buy and hold, in my opinion. And if interest rates go up, which they are currently in an uptrending mode, if they continue to go up during that period, that will really frustrate investors, because then what was supposed to protect you in a decline is not going to protect you. And that is exactly what happened in 2022. So anyway, I'm going to play this, and you'll hear him kind of unpack it and get the view of equities going forward from Sim Carson.
We expected a tariff war, the scale and the kind of rollout of it, the lack of working with the Federal Reserve and the unwillingness, importantly, of the Federal Reserve to help backstop volatility in this environment has been notable. I think we would have expected more dovish responses from the Federal Reserve by this point. That's part of why we thought the market would A, bounce back more, and B, have a less of a deep tail. And that's not happened. Actually, the opposite. When I think the real continuation of the tail, if you think about it, this last Friday was when at 11 o'clock Central, when Powell came out hawkish after the tariff rollout. And I think that's very important in telling in how the future of this move plays out. That said, I think you know this, Adam, I've been calling for this year 35 to 45% decline, peak to trough. And I've done that publicly for 3, 4 months at least. We believe that is not, again, going to happen on this first move. We believe that this is the end of chapter 1 of 4 or 5 chapters. And that this is going to be a process, a move that is much more akin for those who have been in recent history, although a very different move in macro ways. Something much more akin to a tech bubble plus a great financial crisis kind of 1 year plus type move. We don't think it'll cut as deep. Again, 35 to 45% is not the 50 to 75%, right, type things we saw in those markets, depending on the markets you're looking at. But still, in some ways, more painful because relative to what we believe will be sticky interest rates and the long bond, and eventually higher bond yields, which we've called for at the same time, a very stagflationary environment, very different than the last two. The Federal Reserve will be neutered during this time and unable to really assist. And in real, again, relative to the costs that the tape or the thinking of valuations of the market will actually be worse than what we saw in those other periods. Because of and portfolios will be less cushioned by the bond part of their portfolio as well. So a painful, maybe more painful move despite less of a decline in equity markets ultimately.
Okay, now I have 2 other videos to play for you. One is, and I like to do this, I like to show both sides of things. So one is a negative view. This is by Dan Ives. He's being interviewed by Dan Nathan. Dan Nathan and Dan Ives are both credible, well thought of. But Dan Ives has a negative view of the impact of tariffs. And so if you have that view, if you think, tariffs are, destroying our country, destroying our economy, and so forth, if that is your view, you will be able to relate to Dan Ives. And he goes into some detail on that. The second view, which I'll play after this, will be from Stephanie Pomboy, being interviewed again by Adam Taggart. She is more of an optimist. She's not like they're good, but she takes kind of a positive approach to it. 2 very different views of the same set of facts. So let me begin by playing Dan Nathan interviewing Dan Ives.
I'm Dan Nathan. I'm joined by Dan Ives. Only Dan's today. This is Global Head of Technology Research at Wedbush Securities. Dan, welcome back to the podcast.
No, it's great to be here, especially during this time.
You look tired. I mean, let me just tell you, you look tired because every time I look up, you're either on this news broadcast or that news broadcast, and you're actually, kind of breaking things down, I think, to a broader audience than you usually speak to. Obviously, your institutional clients, you come on CNBC, and you're talking to an audience for the most part who can, A, they know you, B, they know the stocks that you cover, you know what I mean? And that's a really kind of important thing. It almost probably feels a little comfortable, right, when you're on CNBC. But to go on some of these broader networks and really talk about what's going on, a lot of these folks are looking at you, hearing from you the first time, and they're hearing about, let's say, the inner workings of a sector, technology, that's been really important to stock market gains over the last 2 years specifically. So let's start. I had a whole rundown here, but This is Thursday afternoon. At one point, the NASDAQ was down 6%. A lot of the names that had rallied really hard on Wednesday are giving a lot of that back. Again, like I said, you look tired. You look great. If you're listening to this, the guy, he looks great, but you look tired. What's going on?
I've probably had,
let's hear it.
Maybe in the last 4 or 5 days, maybe 12, 15 hours combined sleep, the last 4 or 5 days.
What?
Well, because
you gotta take care of yourself, bro.
But in my opinion, in 25 years doing this, it's the scariest time that I've ever seen. And the reason that is as someone like myself, and this is even forget stocks, which is interesting, because a lot of how I've written over the last week, 20 notes, it's writing more as like an American citizen,
Mhm.
like as a U.S. citizen, really understand as someone that understands the supply chain, understands the reality of how we produce the mechanics
Mhm.
of big tech. Look, I think it's these tariffs, in my opinion, could take big tech, the U.S. tech
Yeah.
industry back a decade. You know, when you're playing a game of high stakes poker like this, you're playing with the economy. You're playing with ultimately capbacks, large purchases, and understand the rules of the game. So essentially, what he single handedly has done, I think, as an administration, they've set off a snowball that's going downhill. And for someone like myself that speak to hundreds of people in terms of buyers and our team buyers of spending, in terms of what CapEx looks like projects, I think 15 to 20% of projects, CapEx, automatically halted. Then you start to look at what else could ultimately be slowed down over. And I just believe we're going into an earnings season, besides just new guidance, street numbers already baking in probably 8 to 10% cuts across the board, whether it's NVIDIA, Microsoft, pick your spot. But my view is like the longer this continues, because of the nature of this, because of the nature of what you're bringing in and the impact that tariffs have, not even just on a baseline 10%, when you look what's happened in China, 30% of ships ultimately got turned around. So my view, it's not even just in terms of like these stocks and can they recover and go through it. My worry, and I've talked about it over the last week, is that you are fundamentally taking what I believe is probably one of the biggest assets in this country in terms of U.S. tech and basically taking it back many, many years, China ultimately giving them the leap. And that's really...
All right, so that's something, Dan, a lot of folks are not saying right now, right? They think we hold all of the cards. And I think that's a really unique take because I have not heard that much on CNBC. I have not read that in any of the newspapers.
And I've written about
social.
That. And I've written about that constantly.
So you've gone from somebody that I think folks think, and listen, you can be called whatever the fuck you want.
But
I've heard it all. But I'm going to say you were very
bullish,
optimistic.
And I've been bullish for 25 years.
Yeah.
I mean, I've been a perma, but there's no one that's more bullish in terms of tech than me.
Yeah.
But, like, I could call it like I see it. So when as someone that spent my career in Taiwan, in China, in Asia, Vietnam, understand supply chains, the concept that we're actually going to try to bring Apple would take $30 billion, 3 years to take 10%. If you like $3,500 iPhones, we should make them in New Jersey or Illinois. So the reality is that's why. And then guess what? As all this happening, from NVIDIA to Microsoft, who do you think is ultimately going to benefit? BABA, JD, BYD, Huawei. So the irony is like you're burning your house down yourself, but yet at the same time, it's really China that ultimately holds the cards because where are the raw materials? Where are the chips? And everyone's like, we can make it here. Have you ever been to a fab in Taiwan? Go to a fab for 3 hours and tell me that we could do that here. Where you paying someone $24 to work at Chipotle or Starbucks. The labor, the nature of our infrastructure here, how long it would take, it doesn't work. So the reason that I've been so negative, as someone that's been positive for decades, it's the reality of what's happened. Even when you go back to like financial crisis, .com bubble, COVID, like valuation, where's numbers? Throw out the next 2-3 quarters. What could numbers be over the next 1-2 years? Here, it's systemic. It's a structural thing that's happening to U.S. tech. That's why I've been so outspoken in terms of what's happening.
So as I said, now I'm going to play Stephanie Pomboy being interviewed by Adam Taggart. More of an optimistic view. I don't know if either one of these are right. I don't know. I mean, we just haven't been down this road before. So we'll find out. We'll look back and say which one, or maybe some combination of both of them. So, but anyway, she's takes a more positive view of it. And I think these views of both positive and negative come about from a person's worldview. of how you see the world. And this may even go over into the political realm of, how your political view is of tariffs and so forth. So they don't, neither one talk about that, but that's just a backdrop that I think could come into play. So anyway, take a listen. If you think that the tariffs are not a big deal and maybe positive and we'll get through this and so forth, maybe you'll relate to her. And if you're of the other view, maybe you relate more to Dan Ives. So take a listen to Stephanie Pomboy.
Yeah, well, I mean, I think you and I have talked about this before. I've always viewed the whole tariff, uh, quote unquote, diplomacy as a negotiating tactic. I don't know that I've been persuaded that Trump really imagines an economy that ceases to have income taxes and relies on an external revenue service and tariffs as the main source of revenue for the government. So my sense all along has been that he has been really just trying to get reciprocity and fair trade, and essentially to reshore production here in the U.S., rejuvenate, revitalize our domestic manufacturing industry, as well as things like pharmaceuticals in particular, and other sort of, let's say, strategic and national security type of products. So that has been my operating framework. Now, I may be wrong about that because I have no inside track in the administration to know whether or not this is, in fact, just part of a broader shift to ultimately move to a tariff economy from a income tax economy. I doubt that again. But so within that, if you grant that this is really a negotiating process, then I think it's not surprising that we're seeing these volatile swings in the markets that are just reacting to these headlines with the tit for tat in this brewing trade war. But ultimately, I think the question is, what's the long term picture? And I always prefer to focus on the long term because it gives me a sense of calm and equanimity in an environment where things are hysterical every day. And if you just step back and sort of identify what the bigger picture is here, I think the key for people to focus on, and you and I texted about it briefly beforehand, is what this means in terms of our deficit financing. Because basically what we're doing here is upending the entire sort of globalization quid pro quo that has existed for the last 4 decades and has served as the framework for every investment decision we've made during that time. Was basically the US consumer will continue to be the engine of growth for the globe, and that in response to our willingness to buy their goods, the rest of the world would lend us the money with which to do so. So the real existential question right now is what happens to the treasury market as we engineer this shift from massive trade deficits, where the US consumer is basically supporting growth exporters around the globe, to the US now turning inward and relying on itself to manufacture a lot of the goods that it was getting elsewhere, and therefore no longer needing the rest of the world, well, not, let's say, no longer receiving money from the rest of the world in exchange by purchasing our treasuries. So that's really the issue that I come back to, is watch the treasury market here and how it's reacting to the whole tariff drama. And I think what we've seen in the last few days, obviously, is a sharp increase in long dated treasury yields, and perhaps as a function of China dumping treasuries as a way to kind of intensify the pressure on the Trump administration, but also in so doing, triggering an unwind of this massive treasury basis trade, which gets a little wonky, but basically, there's tremendous leverage built up in the treasury market around hedge funds that were positioning the arbitrage between the cash and the futures market, and that's being unwound. And the catalyst for that unwinding, I would say, is this whole tariff discussion. But again, the big picture is who's going to finance these trade deficits, these budget deficits, in a world where the US is no longer the center of everything, and there's therefore no reason for the rest of the world to be, slavishly buying our treasuries.
Okay, thank you for watching. If you have questions or comments, leave them in the comment section below. And if you've not subscribed and want to, hit the subscribe button and the bell for notifications if you want to be notified. Thank you.